Good morning and welcome to the Inspired PLC full year results investor presentation. Throughout this recorded meeting, investors will be in listen-only mode. Questions are encouraged. It can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Mark Dickinson, CEO. Good morning.
Good morning, everybody, and welcome to the 2023 final results presentation for Inspired PLC. Presenting for you today is myself, Mark Dickinson, Chief Executive, David Cockshott, Chief Commercial Officer, and Paul Connor, Chief Financial Officer. What we're going to do for today is remind you what the business does, ultimately how we help businesses manage that transition to net zero. And ultimately, that's driven by a cross-sell engine, which this year I'm really pleased to be able to bring to life for you through a set of non-financial KPIs that we've published for the first time. Paul and Dave will then work through each division, bringing those to life before Paul focuses on the financials. And then I guess as an ESG company, which is really starting to build a best-in-class service, clearly we have to walk the talk. So I'm going to update you on our ESG performance before giving an outlook on FY24. So if we remember what the business does, over the last 4 or 5 years, we've been transforming into a full suite sustainability services provider. There's 4 divisions offering complementary services, diversifying our revenue line, and ultimately we start with the assurance services division, where we help corporate businesses manage their energy cost equation. Our ESG services division effectively helps those businesses make their ESG disclosures, which are becoming a revenue and investment critical item for businesses. Both of those divisions operate on a process of managing a lot of unstructured data, really starting to solve complexity for each of the customers and managing what is a non-discretionary call to action. But all roads lead to a carbon action program, which really then sets out each business's strategy to deliver net zero. And then our optimization services division actually helps them implement the solutions and actually remove those units of carbon emissions and those units of energy consumption. All that's underpinned by our software services division, which provides our own proprietary software to the marketplace and is increasingly recognized as the market leading platform. These 4 divisions together help our customers manage the 4 C's of cost, consumption, carbon, and compliance. If we think about our customer base, ultimately a list of brand names to die for, and ultimately it's our relationship with these customers, often at C-suite, which really underpins our cross-sell opportunity as we start to help them manage that transition to net zero. The business operates in marketplaces which deal with major challenges for clients, which perform or contribute to effective tailwinds for our business. So the first one is energy crisis defense. The energy crisis of 2020 created a lot of EBITDA and cost shocks for corporate businesses, and none of them want to experience that again. So we find increasingly that businesses are concentrating this at the C-suite level. It's a boardroom agenda item, and one where they're willing to really now start to be creative about how to avoid the potential for future energy cost shocks. ESG gives us a marketplace where ultimately the need to make disclosures is becoming non-discretionary. There's a lot of mandatory compliance regulations coming through, new ones every year, which are bringing more and more businesses into mandatory reporting. But the key thing about this ESG disclosures is ultimately what they do is they also encompass supply chain. So for all the businesses that have to do it, you can multiply that by a factor of 10 in terms of those who are increasingly seeing ESG as a revenue critical item and an investment critical item. The final macro theme is really that transition to net zero. Ultimately, net zero is a societal problem and all corporate businesses need to play their part. Now, one question we often get is, well, is this a flash in the pan? Is it going to endure? So if we look at the government statistics as to what it will cost UK businesses to transition to net zero between now and 2050, in relation to industrial and commercial buildings and improving industrial processes, the estimated cost is 138 billion. Now, where we sit today, we're sitting here with a marketplace where we can clearly see 0.7 billion of that, which would indicate that UK PLC is somewhat behind in its transition to net zero. But what the Inspired platform does is basically provide a pathway to that opportunity to help customers meet that challenge and that cost of delivering net zero over the next 25 years. As we do that, a key element of our business plan and strategy has been our cross-sell opportunity. So we land our clients in assurance services and ESG services where we process a large amount of unstructured data, solve complexity for what is a recurring revenue line, which helps manage a non-discretionary recurring call to action for corporate businesses to solve those challenges. As we do that, we have many touch points with our customers, from the energy manager to the procurement team, facilities manager, investor relations, accounts team, and ultimately working our way up to C-suite. As we do that, we're in the room with those customers when they're actually asking themselves the question, how do I deploy my marginal unit of capital to deliver my next marginal unit of reduction in carbon emissions or energy consumption? And when we're helping with that process, ultimately that leads to those optimization projects where we're actually delivering the solutions into their infrastructure, which remove those units of carbon emission and energy consumption, and actually makes a difference to them in implementing their journey to net zero. In terms of FY23, ultimately, I'm really pleased to report that we've done exactly what we said we were going to do. The transformation we've made into a full suite sustainability services provider was to create a double-digit organic growth business, which I'm pleased to say we did in 23 from both a revenue, adjusted EBITDA and adjusted PBT basis, driven in part by a slight tick up in EBITDA margin. Cash generated from operations was 18.7 million, a little bit down on 2022, but purely driven by the timing of projects towards the end of the year. If we look at cash conversion up to February 24 on an LTM basis, in excess of 100%, and Paul's going to bring that to life for you later on in the presentation. But I think the thing I'm most pleased with is the group's ability now to give investors more insight into actually our operational performance. So we've been building up this diversified business with a cross-sell opportunity, and lots of businesses talk about being able to cross-sell, but not many actually do it successfully. We now have historic KPIs which really show the progress we've been making in this regard. So when we look at our business, the number of clients supported by multiple divisions is now in excess of 600, double what it was in 2020. Not only do we want to increase the number of clients served by multiple divisions, but we want to increase the spend that those clients are making. So we look at clients who spend in excess of £50,000 a year with us year in, year out, and ultimately really pleased to say that's also doubled since 2020. And of those clients spending more than £50,000 a year, more than 219 of them are actually taking services in multiple divisions, which really shows how value creation is driven by that cross-sell process. But the key thing is to actually make a difference to those clients in relation to their journey to net zero. So it's really telling to look at the number of optimization projects we were active with clients in within the year. And so in 2023, we had active optimization projects with clients, 370 of them, again, double what there was, or 2.5 times what there was in 2020. And of those, we've spoken about it quite frequently, but I'm not sure we've been able to evidence it to date. What's really important is that of those 370 clients, more than 50 of them were repeat optimization customers. So what we see is that ultimately it's not a case of just doing one project for one technology. We're in that room helping those customers answer that repeatable demand question: how do I reduce my next unit of carbon emissions, my next unit of energy consumption? And I'm pleased to say that we're really delivering in that regard. We've spoken a lot in the past about really starting to focus on client lifetime value. And to date, what we've been able to show you in previous presentations is some of the case studies where we can empirically evidence that we have clients we've worked with for over 10 years, where their client lifetime value has been in excess of 5, 10, 15, 20 million pounds. And what we've now been able to do is really extend that metric across the portfolio. So if we look at the CLV potential of our portfolio as it stands currently, we've taken the active clients in 2023 and looked at, on average, what have they spent with us each year back to 2020, and then extrapolate that on a 10-year basis. So that shows us that our CLV for the client base, on average per client, as it stands in 23, is in excess of 200k, double what we had in 2020, and really showing the value of starting to grow the relationships with those customers across the multiple divisions. So having gone through the headlines, we're going to ask Dave and Paul now to take you through each division one by one and bring to life their performance for you.
Thanks, Mark. So we start with the assurance business, the foundation of the original Inspired. We are the undisputed market leader in this area. We have our own tier, as it were, on the Cornwall report, just recognising the scale and breadth of our service. It is a high margin business, 40% plus adjusted EBITDA consistently delivered. High customer retention rates, 90% plus. The strong revenue visibility is that more than 80% of our revenue from this area is visible at the start of the year going into a year of delivery. Now, it's true there are relatively low barriers to entry, but enormous barriers to scale as you get to bring on multi-site clients, and the complexity just gets more and more evident. It just makes it harder and harder to grow to a size and scale that Inspired are. What have we done this year? We've concentrated on refining our operations and improving that lifetime value of those clients by creating the opportunity to cross-sell our ESG and our optimization services. We can see that by our higher retention rates and the stabilization of margins. And all of this is augmented by new client wins that you can see on the screen there now.
You'll note the division since 2020 has delivered CAGR revenue growth of 7% per annum. As expected, as the division has responded to the need of our customers, we've seen a reduction in the margin the assurance business has contributed from what we saw in 2020 and 2021 of 78-79% to 45% last year and 41% this year. And that cost has been investment in staff cost, both in terms of FTE, but also in terms of where we've spent that staff cost, with a focus on ensuring that we have the right people to support the customers and deliver the level of service which we believe to be market leading to enable that execution of cross-sell into the other divisions. As Dave mentioned, we go into 2024 with in excess of 80% of the assurance division revenues secured in our order book. So great visibility, with 14% of 2024 revenues expected to come from renewals from existing customers through that high retention rate, and then the balancing 5% coming from new business wins within year. So we aren't dependent within the next 12 months on executing a significant levels of new client acquisition to be able to deliver our 2024 expectation.
Thanks, Paul. So if assurance has a real strong call to action because of the need to buy energy and the need to account for it, ESG has a strong call to action based on obligations of the client themselves, or more as we're seeing it, obligations of their supply chain or investors. If they can't answer the question of what their pathway to net zero is, then their customers or their investors will start to look elsewhere. Remember, we entered this market organically in 2020, using the data that we have, building up our ability to be able to process that unstructured data. We've built the ability to build an audit grade framework agnostic, that the client can choose which of the frameworks they want to report against, and we can support that from a data-driven basis. There are some really strong structural tailwinds that are helping this market as we focus on delivering value in there. CSRD, the Corporate Sustainability Reporting Directive, will capture another 50,000 companies in Europe with the obligations to know where their energy is used and to start reporting on that, giving us great further opportunities.
Thank you, Dave. So since that organic entry into provision of the ESG services in 2020, we've seen a rapid revenue growth of 123% CAGR through to 2023. Also, really pleased to report the ESG division has contributed meaningfully to EBITDA and also cash generation of the group in 2023, following those periods of initial investment into the startup. We know that 2023 did benefit from service provision under the Energy Savings Opportunity Scheme, which is cyclical in nature, and we don't expect to repeat at the same level in 2024. So ESG services generated 1.9 million of revenue from delivery of Energy Savings Opportunities Scheme work to our customers. Stripping that out, underlying ESG growth from 22 to 23 was in excess of 70%. And we're projecting underlying ESG growth into 24 of in excess of 40%. You'll note that we've always said that we believe the ESG division at maturity is a consultative margin, tech-enabled, which would deliver a 40% EBITDA margin, and we'll expect the division to continue to mature and evolve towards that over the next 3 to 4 years.
So optimization, we refer to this obviously as the growth engine of the business. It's where we are actually physically intervening on our clients' sites to help them deliver on their net zero commitments. It's a huge opportunity for cross-sell for us. Whereas within assurance and ESG, that's where we win the customers. Optimization is nearly always a cross-sell from one of those two divisions. Of course, Mark has already talked to the fact that there is an increasing number of clients we have cross-sold to, and more importantly, over 50% of those customers are repeat customers, where they've taken optimization projects from us before, but have come again last year to take those repeat optimization products. As we continue this virtuous circle of answering the question, where do I spend the next pound of capital to remove that next marginal wasted unit of energy and emission? So real strong drivers for this, whether it's cost reduction or carbon reduction, doesn't really matter. Both combined to give a real strong call to action in this area.
Thank you, Dave. Since that diversification of the group from a pure assurance player pre-2020 through to that full suite sustainability service provider, you'll note that the division has generated CAGR revenue growth over that period of 57%. So really strong growth, and importantly, generated 5 million over the last 3 years of additional EBITDA in each period. So noting that the optimization services delivery contributes or delivers a variety of services and products to our customers, we note that the division can generate that increase in absolute GP and EBITDA from a range of revenue growth and EBITDA margin metrics. Noting within the CFO statement this morning, we state that we'd expect to see margins in the range of 20 to 25% for this division. You'll note that the division generated in excess of that in 2023. And as we look forward to 2024, you'll note that we're guiding margins to be nearer to 2022 levels, meaning that to generate that absolute GP and EBITDA growth, we need to deliver a comparable revenue growth to what we've seen in previous periods. But entering the year with real confidence through that continuing growth in our pipeline and expansion of service delivery to our existing customer base.
Software. If optimization is a growth engine, then software is the oil that keeps that engine running. Software is holding the data. We use it for our purposes, for delivering to our customers, so we can record their bills, validate their bills, prepare their budgets, and so on. But more importantly, we also now use it to identify those optimization opportunities. We have a wealth of data on customers, and therefore we can go to them with solutions that are underpinned by that data. But that's not all. We also have direct clients who want to understand their estate data, so they too are direct clients of our software division. Finally, we also have 65 of our competitors that use our software system. We have over 500,000 meters on our platform, making it the dominant software within the marketplace.
Thanks, Dave. So software, ultimately a facilitator for growth within our other trading divisions, but still delivering growth in its own right. So it's seen 12% CAGR revenue growth, noting the only revenue we recognise through the software division are the direct fees we get through providing software to external users. We noted a slight reduction in margin in the period as a result of allocation of central overheads, but we project that margins, being a software business, will increase over the next 3 to 4 years as a result of the operational leverage that we currently have from the cost base we currently have in situ.
Well, so I've got 2 case studies for you this time, just to kind of bring to life some of the features that we are talking to clients about. First one here is Nuffield Health, a client that joined us on the assurance side in 2018. And since then, we've recovered over £1.4 million for them in billing errors. We've then moved on to look at their water and water efficiency, securing £170,000 worth of savings. Then the forgotten contracts, the meter operator contracts that are just enablers that never really get much attention, but we've been able to secure £116,000 cost saving by consolidating those. Just to demonstrate the variety of products and service lines within the assurance division that have then led on to further products within the ESG division, and now looking at the optimization services that will really make a difference to the actual consumption. The next one, though, is where we have done the optimization as well. Again, 2015, started on the assurance side. Since 2016, all the way through to 23, though, you can see this nature of the repeating, answering that question, what do we do next? Whether it's LED upgrades, whether it's bespoke building management systems, refrigeration enhancements, and so on. All these steps are answering that question of how and where do I spend the next marginal pound of capital to reduce and remove that wasted kilowatt hour of consumption and emissions. With CSRD coming in, the need to understand where energy is used across their worldwide estate has given the opportunity for a smart metering implementation across their worldwide operations that we will be working with them in 2024 on. So lifetime value now well in excess of £5 million as an example of the optimization repeatable demand client.
Thank you, Dave. So just to reflect on group performance, since that diversification pre-2020, at which point on the right-hand side there, you can see 90% of our EBITDA came through our assurance business, through to that diversified sustainability service provider, in which now 45% of our EBITDA comes through optimization and 5% through ESG. You can see that over this period since 2020, the group has delivered broadly double revenue and double EBITDA, and also put the cost in place from a central cost perspective to enable that execution of the aspirational doubling of EBITDA from the levels we saw in 22 through to 2027. So in terms of cash flow in the period, 75% underlying cash generation, which was slightly lower than we'd expected at 80%. And that was because of the timing of our optimization project. So we had a real strong Q4, H2 weighting, which is what we've seen in 2022 and also 23, and also expecting in 2024. But noting that as that working capital unwound from the balance sheet at the year end, last 12 months cash generation to the end of February 24 was in excess of 100%. You'll note across 2023, on a last 12-month basis at each month end, the business generated in excess of 85% of cash generation, which gives us that confidence in guiding to in excess of 85% in 2024. Clearly, in terms of investing activities outflows, contingent consideration, as expected, remained a material outflow. So we paid 12.1 million in 2023. We're expecting to pay a further 10.6 million of cash in 2024, which represents that balance on the balance sheet within current liabilities, with a further 2.6 million we expect to satisfy through the issue of shares to the vendors of Ignite Energy. The balance sheet at the 31st of December 23 very much represents an inflection point for contingent consideration from those transactions we completed in 2020 and 2021 in the depths of COVID, in which we protected shareholders against downside risk by paying initial consideration based on the performance of the businesses during COVID, and then contingent structures whereby we would pay for delivery of the growth plans of those businesses over the following 3 years, as stated at the time. The balance sheet at 31st December 2023, the current liability represents the conclusion of those SPAs, which we said will be funded by the balance sheet, and those balances will be paid within 2024. And then the non-current liability of 5.5 million represents, or wholly represents, the value in terms of the deed of variation we entered with the Ignite vendors in May 2023, subject to delivery of growth trajectories from 24 through to the first half of 2027. The key note from this morning's RNS in terms of net debt was that as these contingent consideration structures conclude, we have confidence that we will expect to see a reduction of net debt to EBITDA to nearer 1 times by the conclusion of 2025, noting that the maximum contingent consideration payments after the final payments in 2024 will be up to 2.3 million per year versus 10, 11, 12 you've seen over the last 3 years between 25 and 27, which gives us real confidence in that net debt to EBITDA reduction to nearer 1 to 1 times by the conclusion of 2025.
So thanks, everybody. I think in terms of that bringing to life the divisions and the performance, you know, the transformation we've been on since 2017 and the ability to have that organic double-digit organic growth engine, which really plays to that cross-sell thesis, now evidenced by non-financial KPIs, is a great step forward for the business, and one that we expect to go into the future as we look to continue our journey towards our aspiration of doubling FY22 EBITDA by FY27. Clearly, a key facet of that is our ESG services, where we are increasingly confident we are the market leading service at the market leading price point, noting that actually one of our customers was an award winner this year in terms of best sustainability disclosure by the investor relations body. And I guess kind of ultimately what's important therefore is that what we need to be doing is actually walking the talk ourselves. So in terms of our own ESG, we aim to be transparent in everything we do and the progress towards our targets. And as such, we voluntarily disclosed to a GRI standard and on TCFD for the last 4 years, along with meeting obligations on SECA and the Carbon Disclosure Project, and really pleased to have received yet again the Green Economy mark from the Stock Exchange, which is testament to the credentials of the business. We're an early adopter of TNFD, the Task Force for Nature-Related Financial Disclosures, which ultimately starts to bring biodiversity into the purview of corporate businesses and their responsibilities from a ESG perspective. In 2023, the group revised its Scope 1 and Scope 2 net zero target to make it more ambitious by bringing it forward from 2035 to 2030, which is underpinned by a move to a new corporate headquarters, where we're in the process currently of removing all of our Scope 1 emissions from that facility. So if we consider FY24 and beyond, ultimately, the business has never been better placed to support UK businesses to deliver net zero and manage the estimated £138 billion opportunity, which represents the cost to UK businesses as published by the government between 2024 and 2050. Strong start to Q1, particularly pleased with the cash generation, as Paul's mentioned. And as I just mentioned, great progress on our own ESG strategy and delivering our targets. Ultimately, the cross-sell engine we developed, which isn't something that we're planning to do, but something that we now can demonstrate to you, we have a proven track record of doing, that really underpins our strong organic growth and ultimately our aspiration to double adjusted FY22 EBITDA by FY27. Thank you very much, and move on to questions.
Fantastic, Mark. Thank you and the team for your presentation. Ladies and gentlemen, do please continue to submit your questions just using the Q&A tab situated in the right-hand corner of the screen. Just while the team take a few moments to review those questions submitted today, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your dashboard. Paul, if perhaps I may hand over to you. As you can see, we've received a number of questions throughout today's presentation and pre-submitted as well. If I could just ask you to read out where appropriate to do so the question and give your response, that would be fantastic.
Yeah, thanks, Paul. So first one, at the current share price, what doesn't the market understand about Inspired PLC? One for you, Mark.
Yeah, sure. So, I mean, I think kind of ultimately from doing what we said we were going to do point of view, we've done exactly that. So from the point of making the strategically important acquisitions of Ignite and BusinessWise during the COVID period, clearly circulars were published and we set out exactly what we were going to do. And we've delivered on that. So we have that double-digit organic growth engine. We have transformed into a full suite sustainability service provider. And I guess kind of ultimately we've done that staying within the leverage commitments that we made at the time, being less than 2 times EBITDA. I think kind of ultimately when you look at the performance we've had, we're in a position where we continue to do what we say we're going to do. We say it in advance and the market gets to observe whether we've done it or not. In terms of what the market may not be understanding at the moment, I suppose, is ultimately that as we go forwards and the final parts of that contingent considerations paid, which basically allowed for those strategic acquisitions to be made, we're in a place where the board has a clear commitment to make sure that we are reducing leverage through to 1 times in 2025, which ultimately, I guess, is something that as we do that, hopefully the market will start to recognise the value of the performance that we've delivered, noting that, I guess since 2017, we've increased revenues by 5 times and increased EBITDA by 3 times.
Thanks, Mark. So next one, we're going to cover these together. It's what's your strategy for growth, and do you intend to make any acquisitions in the next 12 months?
Yeah, so I mean, hopefully this growth strategy is clear, and not only that it's a strategy, but something we're actually executing. So the non-financial KPIs give you a really clear evidence of how we're delivering on the cross-sell opportunity and how we're increasing that client lifetime value. And it's all about being able to support those clients on their transition to net zero, which is a great overall kind of opportunity in terms of adding value to our customers as they meet the challenge and the cost of doing so. So I guess that growth driver is there to some fantastic macro themes. We add value to clients in areas where there's complexity and ultimately they have non-discretionary call to action. And just I suppose as relatively before, just, you can see the amount of growth we've delivered since 2017 and since 2021, that growth has been organic. So ultimately people could say, oh, well, you acquired your early growth. We absolutely did, to be able to transform into the diversified business we are today. So in terms of going forward, I think we see ourselves well placed with our current momentum to continue executing the thesis, which is one that's underpinned by macro drivers, which are not just short term, but actually in terms of net zero, have a 25-year lifespan, at least from today. In terms of M&A, we've been really clear to state that there's M&A opportunities in the market. You can see things that can be a potential, but our priority is reducing our leverage to 1 times EBITDA. We're going to look at focusing on achieving that first, and then effectively we can take stock in the future. But the firm priority for us is to making sure that we let the substantive growth engine and cash generation of the business feed through to deleveraging by the end of 25.
Thanks, Mark. What do you think the greatest challenges are for companies like yours that get in the way of growth?
I mean, I guess kind of ultimately when we look at kind of the macro environments from the other side that customers have to deal with, our ability to continue growing in our services is also dependent on our clients' ability to be able to actually meet that challenge net zero. So if you had macro factors that meant they couldn't deploy capital, or they were in a situation where they were having to focus on events in their own businesses that were ultimately potentially different risks or threats, then that would be something which could potentially slow down our growth. We do note, however, that ultimately the challenges we help customers meet do tend to be non-discretionary challenges. Everyone's got to have an energy contract. Everyone is increasingly driven through regulation to need to produce ESG disclosures and deliver net zero. So I think there can be some maybe phasing to the growth as you look at various other macroeconomic factors that might be facing individual customers, but ultimately that becomes phasing as opposed to something that would detract from our growth thesis.
Thanks, Mark. Just following on from the question around growth strategy. So what are the competitive advantages of the inspired optimization service delivery versus the competition in an increasingly crowded market?
So I think first of all, we're technology agnostic. So we're not selling a particular solution or a particular piece of kit. And I think the other thing then is just the fact that we are not going around and trying to sell a solution like an LED solution or a building control solution or a heat decarbonisation solution. What we're doing is we're working with the clients, answering that question, how do I reduce my next marginal unit of carbon emission, and how do I reduce my next marginal unit of energy consumption? And we're doing that in the room with their C-suite, with the C-suite of the customers. And in doing so, when we go into those rooms, we're making those suggestions and working creatively with their teams based on data. So we've already, through our assurance services and our ESG services, have all of the millions of pieces of data that are required to make an assessment on what is going to add value to their portfolio and their situation, and what the paybacks are going to be, how it's going to meet their return on capital criteria. And ultimately, when we're working collegiately with them, we get into a very nice process of being able to say, hey, look, we can deliver this. Let's do a pilot. Let's look at it. Let's prove it's true. And then once we've proved it true, we've all worked together to get to that collegiate solution, let's roll it out in phases. Let's do 10 premises, let's do 20, and let's check they work. And then let's do 20 more. And suddenly before you know it, in 6 months, you've done 100 and 150 premises. So from that solution, it's a really nice iterative way, which if you're just selling equipment or you're just selling a particular solution, you first of all have got to get to meet the customer. You've got to work your way up to C-suite. You've got to then request some data, do the analysis, and then ultimately differentiate why your solution is better than another, noting that a lot of their solutions won't be technology agnostic. And I think the really thing that then really drives the competitive advantage is all the time the customer will be going through that process with a third party, they've got leakage. Every month that goes by, if they are not achieving best achievable performance from their portfolio, then ultimately they've got waste. That waste is in the form of energy cost, and that waste is in the form of carbon emissions. So ultimately, when we're working with the customer, because we know them well, we know the sites, we know the health and safety procedures, we can deploy quickly. So the difference between working with us collegiately as the turnkey solution provider could be 6 months worth of time. That 6 months worth of time has got 6 months worth of wasted cost and wasted carbon emissions for the customer. So ultimately, we become very confident that we can deliver the best solution on an overall holistic basis.
Thanks, Mark. One for Dave. Assurance margins have come down. Is this driven by increased competition or reflection on finding it harder to keep clients in terms of churn?
Well, yeah, you're right. The margins have come down, but that was a conscious choice during the energy crisis to say we recognise that winning at this game is actually creating this kind of stable, sticky, and happy customer base that we can sell into and develop that lifetime value. So during the energy crisis, we diverted additional resources into that area to make sure that we could respond to their kind of increasing needs and concerns. And more importantly, the breadth of that leadership that was looking at those clients. So we organized ourselves into smaller client-focused areas that gave leadership coverage to more and more clients, which just helped support and reassure them and to build their confidence in the solutions that we were providing, which I think was very, very important at that time when many customers were really, really worried about some of the prices that they were seeing. So by doing so, we brought the margin down, but it's protected that customer base and has led us to delivering those cross-sell numbers that you can see.
Thanks, Dave. Just another one while we're on assurance. What is the market trend in pricing for assurance services? And is there a potential for increased pricing to recover some of that margin?
Yeah, and I guess the key word there is potential, isn't it? So there always is. Bear in mind, we're signing longer term contracts in the assurance division. That's why we've got the great visibility. But that does mean, of course, there is a bit of a lag between price adjustments. So, of course, there'll still be competitive tension when it comes to renewal. So it's not like we're always going to be able to increase prices on every one, but there will be the opportunity to pass through some of those cost increases as we price into the future.
Thanks, Dave. One for Mark on ESG. Noting the good growth in ESG in the period, can you see this getting to the scale of margin and contribution we see within assurance and optimization services?
Yes, I mean, I think the first thing is from a standing organic entry, the performance has been remarkable. And the fact it's actually meaningfully contributing to EBITDA after only 3-4 years is just great. I think going forward, we're looking at being able to continue that momentum. We expect at maturity this division to look really similar to the assurance services division in terms of financial profile. So you'll be looking at in excess of 4% EBITDA margins, and we'll be looking at those long-term contracted revenues that operate on a recurring basis. So I think kind of ultimately that as the division grows and reaches maturity, that margin contribution just naturally happens to reflect the fact that you're not having to invest in what is effectively a startup. So I think from our perspective, the way to think about it is that you can extrapolate out the kind of the growth, and you can sit there and look at normalization of margin. Will it reach a scale of assurance and optimization in our 2027 aspiration? Probably still some way to go from there, but actually it will be a meaningful contributor on an EBITDA basis.
Thanks, Mark. One on software. So what are the barriers to accelerating software services growth in its own right?
So I think at the moment, obviously noting that the software business, we're only bringing in the external revenues, we see a lot of potential for upsides here. So I guess kind of the division's been building out more and more modules, and kind of as we've been investing our capex in software development, and a number of those are launching in 24. A few of which we think we've got some exciting opportunity to really move the dial on the benefits given to client, and hence the revenues we would achieve. Clearly, we don't guide to that until we've actually sat there and delivered it. So what you've got at the moment is the business usual momentum. But from our perspective, I think we've been doing a lot to put ourselves into a situation where all the right pieces are on the board to accelerate that growth. And now it's just purely execution. So in short, I don't think I've particularly got a barrier. I think what I've got is a lot of latent potential there, and it's our job to realise it over the next couple of years.
Thanks, Mark. Capitalised intangible investment in the year, 5.6 million. What has that been spent on? And then what should we expect in terms of spend moving forward?
Yeah, so I guess kind of the that largely is the software investment, and I guess kind of in terms of doing that, we invest that kind of quantity in software because we're really doing two things. Energy is a technology laggard as far as technology is concerned, and ESG is a nascent market where actually the final solutions are still being prototyped and determined. So I guess kind of what that says to us is we've got two things that we spend our capex on. One is making sure that the services we deliver, the quality of those is improved to enterprise level solutions, where ultimately you're investing to make sure that the full range of needs of the client are met through enterprise level software. And then you've got kind of actually part of it being used to then push the boundary of what we do, so that we're not just solving the challenges customers have today, but trying to solve the anticipated challenges tomorrow to make sure that in a way we're self-disrupting our own market and reducing our vulnerability to any future technology disruptors. So we see that as an important part of our strategy, and one reason why we like having, if you like, a standalone software business that operates widely across the market. I think in terms of future guidance, correct me if I'm wrong, Paul, we kind of maintain it at the same level as far as guidance is concerned?
Yeah, absolutely, in the near term.
Yeah, so I think kind of ultimately our expenditure in this regard is a choice every year. At a certain point, if we decided to stop pushing the frontier and we decided that actually we just want to make sure we keep what we do market leading and relevant, which is very different to maintaining, you do need to keep actually making sure that your solution is protected against potential disruptors. Then I think you could probably say that you could take the choice to half that capex number if you so chose to. At the moment, we don't guide the market to that, but we do review each year to make sure that we're comfortable that the technology, which not only drives the software business revenues, but more importantly underpins all of our technology-enabled service, to make sure that we're kind of targeting that expenditure in the most appropriate way and at the right level.
Thanks, Mark. And that concludes our Q&A.
Fantastic. Look, Mark, David, Paul, thank you very much indeed for updating investors and, of course, taking all those questions. Any further questions that do come through, team will have the opportunity to review those and we'll publish responses where appropriate to do so. Before redirecting investors to provide you with their feedback, and it's particularly important to you and the team, Mark, could I just ask you just for a few closing comments, please?
Yeah, so I mean, I think as an organisation, really pleased that we've been able to do what we said we were going to do, which is create a business that would deliver double-digit organic growth. The transformation's been really pleasing to see, and the ability to give investors more insight to that through our new suite of non-financial KPIs is something that hopefully will be appreciated and allow investors to really understand the progress we've been making. I think our drive to make sure that our cash generation flows through to deleveraging as we get to the end of the contingent payment structures should hopefully be clear to everybody. And from our side, what we're going to be focusing on is making sure that we continue to deliver that double-digit organic growth strategy, really making sure that we focus on helping customers in their transition to net zero, that £138 billion opportunity between now and 2050.
Fantastic. Mark, David, Paul, thanks again for updating investors today. Can I please ask investors not to close the session? You'll be automatically redirected to provide your feedback in order the management can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of Inspired PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good morning to you all.